Hello traders, it's Sunday, June 9th. It's about 4 o'clock. We got the S&P futures opening in another hour or so. Every one of these videos starts with a review of my previous picks. Now I took a couple of weeks off, got some much needed R&R, time to get my head back in the game. So I've been back for about a week or so, but I haven't been able to get the live videos out. My last highlighted pick came during my live event on Wednesday. If you haven't had a chance to check out our live events, please make sure to do so. You can even watch the recordings. We answer a lot of the questions that you have. Chances are the questions that other traders have are also questions that you have. So make sure to check out the live events. Qualcomm, QCOM, was the stock that I highlighted last Wednesday during our live event. You can see how the stock has had a nice rally post earnings. It's above AVWAP-E, above the EMA 8, so we're not reaching, we're not chasing. Stock had a nice little breakout right in here on Wednesday, and I like that. I thought that was a sign and a chance for it to continue to build. So I still like Qualcomm. You can see by the historical IV study that we have, the IVs are around 30, which is relatively cheap. That means that we would be leaning towards buying longer term meaning 2 months until expiration, maybe 3 months until expiration, buying those deep in the money calls. Here you might be trading the $200 calls, perhaps even the $195 calls. We want that high delta. We want lots of time because we don't want to be exposed to time premium decay, and we want to let this stock continue to just float higher as it's been doing. So I still like the pick. Right now we don't have a market that's moving very much, so let's do some market analysis, get our bearings, and form our bias, and then we'll go through the process and we'll find another pick. So I still like Qualcomm, but you can see here's what the market's done recently. So we had this beautiful rally from November through March, and then the price action starts to subside. The momentum is sideways. We don't really have a strong trend right now, and we get this little pullback. And we knew that from that bearish engulfing candle that we were going to see two-sided trading and that a dip was very possible. So given the strength here, we knew that once this dip found support, there would be a buying opportunity. So we bought here, and we bought on the breakout above AVWAP-Q and the 50-day moving average. And then now we've kind of been in a holding pattern. The market hasn't done much one way or the other. So here we get another bearish engulfing candle off of a new relative high. That suggests that we're going to see a little volatility and a little selling pressure. You'll also notice that on this breakout and this rally, look at the volume. It is terrible. Way below average volume. Well, that's a sign that there's not much conviction by buyers or sellers. And you can see here that the previous high acted as support. We tested it, and now we're back above it. This is a marginal new high. So what we would like to see ideally in a nice, strong, bullish trend, you would see a pullback, and the pullback would not be quite this deep, and it would not last quite this long. And when we bounce from the pullback, we bounce violently. So you get a little pullback, maybe it lasts a week, week and a half, and then stack green candle, stack green candle, stack green candle. We blow through the previous high. That is bullish. So the longer the dip lasts, so the more prolonged it is, and the wimpier that the bounce, the worse from a bullish standpoint. It tells us that buyers are not super aggressive in here, and that's exactly what's played out. And we've seen by this marginal new high, when we made a new high, which you would like to see on this breakout, is lots of shorts who are going to get squeezed. They've got to come in, they've got to cover, and you want to see buyers just aggressively buying the market. Boom, 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 off to the races. Don't look back, just go hard. That is not even remotely what we're seeing right now. So that tells us that the market is likely to be trapped in a trading range. We're not going to see a lot of movement one way or the other. I'm looking for anything that might excite buyers in this current market environment, and I can't find it. I'm not seeing it. So on an economic basis, we'll take a look at the fundamentals. We've just looked at the technicals. The technicals are telling us this market is not going anywhere fast. We have very little volume. We had a dip, so we know there's some selling pressure. When we rebounded, we barely made a new all-time high. And when we did, boom, instantly we get a bearish engulfing candle. And the volume has been atrocious. So now we're waiting. We're waiting for the catalyst. We're waiting for news. Earnings season is over. That's not going to drive the market. We had a big dose of economic releases last week. So the positive out of the economic releases is this. The economy is still strong. We had ISM manufacturing did come out last week. It was in line with expectations, but the bigger number is ISM services because 80% of our economic activity is tied to the services sector. ISM services came in at 53.2, well above the 51 that was expected. And a month ago, it was somewhere around the 49.6 level. It had actually fallen into contraction territory for the first time since December 22. That is a soft patch, and that would get the Fed's attention if we had a couple of consecutive poor ISM services numbers. We also had fairly soft GDP, came in around 1.6%. It was about a 2% decrease from the previous quarter. That's substantial. So the market was kind of looking for additional weak economic data points that might push the Fed closer to easing. And so when we got that good ISM services number this week, we had a nice big rally. Haven't been able to add to that rally. Market kind of stalled out. We got a good jobs number on Friday. So from my perspective, the jobs report, we had 275,000 new jobs created. That is excellent. So right now, the economy looks to be on pretty decent footing. The Fed is not going to do anything, and they've got a meeting this week. So we're going to get the FOMC statement on Wednesday. And the bad news is good news crowd is not going to be happy right now because the Fed is not going to do anything. They've seen good job growth. They've seen a good ISM number. We've had a number of other economic data points that are stable. So the economy is not falling apart. Inflation has continued to be persistent, and we get CPI Wednesday before the open. So that's going to be our busy day this next week. CPI before the open on Wednesday. I'm not expecting a whole lot of surprises there either. The market is kind of adjusting to the fact that inflation is gradually starting to subside, but it's still more persistent than what the Fed would like. It's still higher than what the Fed would like. Economic growth is still intact. Our economy is not falling off a cliff. So the Fed is probably just going to stay right where they are. I don't even think that they're going to reduce quantitative tightening this week. So CPI, I think, is going to come in along expectations. I think the Fed is going to say, hey, we're happy with where the economy is right now. We'd like to see inflation come in a bit. So a great big nothing burger. I think this whole summer could be a great big nothing burger. And if we get through the summer and now we're into the pre-election phase of the year, we might not move a whole lot because of the elections either. So I'm thinking the market is going to be trapped in this trading range. And given that we have this marginal new high and given that we're at the top of the range, I'd be a little bit more inclined to right now sell out of the money bearish call spreads. Now that is a neutral keyword, neutral to slightly bearish strategy. And if we got a dip like this or a dip like this, then I would be more inclined to sell out of the money bullish put spreads. Again, the notion being that my market opinion right now is neutral. Flat out neutral. I don't see us going one way or the other fast. And since we're at the top of the range, yeah, I could see selling some bearish call spreads on stocks that have already shown weakness. So that's what we're going to be looking for. Is there room right now to get long some really strong stocks? Yes, there are. Qualcomm will be a really nice candidate for you if the market pokes through and makes another little high after the FOMC statement. Yes, Qualcomm would be a great stock to look at. So I'm going to give you something to look at on the bearish side, and I am not outright bearish like this stock is going to tank. I'm just simply trying to sell some out of the money calls on the notion that the stock won't rally and that we'll be able to take advantage of accelerated time premium decay. So I'm going to be looking for options that have some juice in them. That allows me to distance myself from the action. And so I ran a search, and I'm going to bring up custom search so that you're able to see the search criteria that I used. And so let's just go through all of them. I'm looking for a stock that is weak relative to the market. I'm looking for a stock that is on a bearish signal right now on a D1 basis. So longer term, we've got a stock with relative weakness. We have a stock with a sell signal. Now I'm going to continue to go down to the lower section. I'd like to have a stock that's at least above $30. I'd like to have decent option liquidity. And the reason for wanting a stock that is above $30 is that if I get to a stock that's trading at $15 or $20, I'm not going to be able to distance myself from the action because the strike prices are not as far away from the money as I would like, and the premiums are not going to be as rich. So I'd prefer a little bit more expensive stock where I can sell a little bit further out of the money. So a stock above $30 should be fine, and I want decent option liquidity, 0 or higher. I'm looking for option IVs that are above 35, and I could move this all the way up. Wouldn't even matter what I have for a max on IVs. You do need to be careful. You wouldn't want to have like something around the 5 level, because then that implied volatility could be there for a reason. There could be really big litigation or news pending. I don't want any ETFs. I want the stock to be below the prior day's low. And so Friday we had really almost a doji. The market closed almost where it opened on Friday, but this particular stock would have been below the prior day's low, which shows us some short-term weakness. I'd like to have a stock that is below the 200-day moving average and is below the 100-day moving average. So even with the market bouncing and moving higher, this stock has already shown some weakness. Now, before I start flipping through charts, what I'm not looking for is a stock that's dropped 5 or 10% in the last few days. Then I'm chasing. Okay, the stock has already made its move, and the market's really not doing anything. I want a stock that in a nice orderly fashion is just drifting lower, and that still has the 100-day moving average, the 200-day moving average, AVWAP-E, 50-day moving average, horizontal resistance. I want to see some resistance above the stock that it would have to break through for my spread to get into trouble. all of those resistance levels are providing me with cushion. It's going to be harder and harder and harder for that stock out of nowhere to rally and blow through those resistance levels, because those are natural levels that are going to attract sellers. So let's take a look at what we've got, and I'll go through all the candidates since we don't have many, and Affirm is first on the list. So I'm going to move this to the side so we can take a look at the stock. This is the kind of pattern that I'm looking for. You can see this is a gradual, bumpy drift lower. Nice, tight, orderly fashion. And it's below the 100-day moving average, the 200-day moving average, it's below the 50-day moving average, it's below AV/WAP-E. If I hover over historical IV, I can see that it has a 66 IV. Those options are rich. I should be able to sell those calls above this major resistance level. So here's why we want resistance. Bump, 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 trying to get through this resistance level. Just can't do it because there are sellers. This gives us the cushion that we need. So I like this drift lower. You can see when the market's been up, up, up for the last few months, this stock has been drifting lower. That tells me there's selling pressure. This is going to be a nice candidate for us to sell some out of the money calls on. And I'd like to stay within 3 weeks. And I'm going to go out to the July expiration, because think about it. We just had a holiday, Memorial Day. We're going to have another holiday. Juneteenth is coming up. So that's going to take probably the day before and the day after the holiday out of the equation. And then, hey, we got 4th of July coming up. Another holiday and more days when people are going to be taking vacation. Tick, tick, tick. Time premium decay happening all the while. And so we're going to want to be below the 100-day moving average, and you can see where that comes into play. 200-day moving average at 32. And so let's see what we can get. And these are the July 5th options. So let's see what we can get for the 32, 34 call spread. Now, there are $2 between the strike prices, so I'd like to bring in at least 40 cents on this spread. That is 25% return on my investment. So I've got to put up $2 between the strike prices, less the credit received, which is 40 cents. That's $1.60 that I have to put up for this trade. If I collect 40 cents divided by $1.60, my margin requirement is 25%. So if the stock stays below the 200-day moving average for the next few weeks, so we've got a few weeks to get through, and 2 holidays in there that are going to strip out a lot of action, I'll get to keep the premium that I sold, and it's going to generate a 25% return, and the stock has drip, drip, drip been declining in a strong market. And I've got these major resistance levels that are going to provide me with additional cushion. Plus the stock trades with very high IVs, so I didn't have to go way out in time to put this spread on. And you can also see that the market has not done a whole lot of anything, and it's not likely to do anything. So I could envision that the market continues to maybe drift higher a little bit, but I'm not looking for any fireworks from the Fed. I really don't expect them to say, oh, we're going to start cutting rates in September because why? They don't have a reason why. They're really leaning on economic conditions being strong and inflation being persistent, and they have dug their heels in. They got inflation wrong. 2 years ago. They're not going to make the same mistake. And so I believe that you're going to get a great big nothing burger out of the CPI and out of the Fed reaction this week, even if the market rallied. Look at this rally that we had from this low on April 19th to June 2nd, let's say. Big rally. Let's say we get another big rally in here. Look what the stock did. Nothing. It sold off because there are people selling this stock down. Any little rally is going to get whacked down. They're going to play whack-a-mole with this stock. So we've got that longer-term trend working for us. We've got major resistance. We got a market that's going nowhere fast. I like that spread. July 5th expiration, sell the 32, 34 bearish call spread, bring in 40 cents, and I think you might even be able to get better than 40 cents. Well, hey, Pete, what if I went above that 200-day moving average? What if I sold the 33, 35, and I were able to get 40 cents for that? 23 cents bid, offered at 52. Yeah, of course I like that even better. So if we do get any kind of little pop on this stock Monday or Tuesday and you can get this spread done, yeah, I like that one even better. That gives us a little more distance and we're even above that 50-day moving average, which comes into play at 32.27. So yeah, absolutely. See if you can get that spread done for 40 cents. So let's take a look at some of the other candidates and I'll tell you why I might like them or why I don't like them. So I'm going to put this off to the side so we can see the charts. CZR came up $36. So this is not a bad play because you can see lots of weakness here. And this is just a bounce and you've got this long green candle, probably a short covering bounce. Off of a short covering bounce like this, I'd like to see the stock spend some time sideways with the rallying market, because that tells me that this was only a bounce and it's just a matter of time until sellers come in and start to nail this stock again. We've got horizontal resistance here. We've got a 50-day moving average right here. That comes into play at 37.61. So let's take a look at those options very quickly. And we'll go out to the same expiration on July 5th, and we'll take a look at those 37s. So here we'd be selling, I mean, I don't have to look very far. Look at these bid-ask spreads. 70 cents bid offered at $2.05. 60 cents bid offered at $1.77. No, thank you. I'm not going to play in that market. There's not enough liquidity, and if I take that trade, I could really get stuck in that. So no, I'm no interest in that. Docu, I think same thing. I took a look at that. It's got some pretty wide bid-ask spreads as well. And you can see how the stock did finish below the 200-day moving average. Post earnings here, breakdown. You've got not really any trend lines that have come into play. You've got one possibly right here, but it's pretty much in line with that 200-day moving average. So this is a negative reaction, but the stock sold off pretty hard on Friday. Market closed near its low of the day, bearish hammer. Stock was able to rally most of the day and close near its high. But yeah, this is a pretty decent breakdown, but pretty chunky, choppy stock. I'd rather see one like a firm with a nice, gradual, steady downtrend. IoT, this is a pretty big drop, so I don't want to chase. I'm not looking to chase a stock that's already made a big move like that, because there's a good chance if I sell an out of the money call spread, boink, it rallies right back. I don't want that exposure right now. I want dull. I want boring as all heck. Like the stock just doesn't even want to do anything. It doesn't even want to move. That would be consistent with a neutral market strategy and selling time premium. SEDG, nice gradual drift lower. My only concern with this is that I don't have those major moving averages to lean on. You can see how far below the 200-day and the 100-day and the 50 it is. So you've also got a downward sloping trend line here. Yes, that could provide some resistance, AVWAP-E, but yes, I'd be having to sell an out-of-the-money bearish call spread, maybe at the 55 strike. The premium should be pretty good. Let's see where those come in. IV at 64. I just don't like this as much as the other trade. AFRM looks much better to me for that reason, just because we're farther away from these major moving averages. But this downward trend is definitely something that I would want to take advantage of. So decent candidate, but not as good as what we've already found. So we'll take a look and see what else we've got here. SNOW. And there you can see this is a nice little breakdown here. What I would like to see is I'd like to see a little bit of a pop in the stock. You can see how it's below the EMA 8. Give me a little pop back up to that AVWAP-E. Then I've got horizontal resistance. Okay, that was support. Broke down. That's a nice breakdown. Post earnings. Earnings came out. No likey. Stock selling off pretty hard with a market that has been marching higher. Relative weakness. Good volume. This is a weak stock. I don't need to chase. So I right click. I create an alert because I am looking for a swing trading opportunity. I'm going to use a longer time frame. LSRI is going to be below 20 already. I want it to rally above 80. You can see that right here in the chart. Okay, this is LRSI. It was below 80 there. That would be a sell signal. And now it's below 20, so it's staying on that sell signal. I want to see a nice little pop in it, and then I want to see it pull back below 80, and I want to see it preserve AVWAP-E, and that horizontal was support, now resistance, somewhere in that 145 level, $145 level. So I would click and I would select M30 for my time frame, and I want to see LRSI below 80, and then I would click plus and I would save that alert. That is how I set up a future swing trade. And so let's go into a 30-minute time frame. I could tell you it's going to be down around 0. And yes, it's down around 0. So what I'd like to see is a rally like that. Okay, there's your LRSI getting above 80. Now it comes below 80, and our servers know that it is currently below 80. It's waiting for LRSI to go above 80, and then when it comes below 80, we're going to get our alert. How sweet is that? And then you look at it and you go, hey, that really wasn't much of a bounce in here. This downward trend is still very strong. And versus the last time that LRSI was above 80 and crossed below it, which was here, the stock is lower in price than that point. So it's continuing to make lower highs. Bingo! That's what I'm going to be looking for. And I'll get that alert because of what I just did. If I didn't explain it to you, it would take me seconds to set that alert. W was the last one on our list. This is some choppy price action. No interest at all. Well, why not, Pete? It's below the major moving averages. It's got relative weakness. Looks good to me. Because at any moment's notice, what has the stock done before? Boink! Uh-oh, it just rallied $10. I don't know why it rallied $10. I know why it rallied $10. Because that's what the stock does. This kind of chart you should avoid like the plague. This is not nice, orderly price action. This is choppy as hell, avoid at all costs price action. So, final review, market, not doing anything. I am very neutral in here. On a day trading basis, I would be equally inclined to trade shorts as I would be to trade longs. On a swing trading basis, I'm going to be looking to sell out of the money bullish put spreads when I get any kind of dip like this that finds support, any little dip like this that finds support above a technical level. In this case, you had AVWAP-Q. Market couldn't quite get down to that or the 50-day moving average, and it found support. Here it was the 100-day moving average. So get a sell-off, nice. Sell your bullish put spreads. Sell off, sell your bullish put spreads. You get a rally up to a new relative high with a bearish engulfing candle. Okay, probably a good time to sell some out of the money bearish call spreads on very weak stocks on the notion that the market, if it does go higher, is going to just barely even eke out any kind of gains on light volume. And the stock that you're selling these out of the money bearish call spreads on has already shown weakness. It has not been able to rally with the market. So if the market continues to move higher, it's not going to rally. You've already seen that type of selling pressure and that weakness. So I'm just trying to generate a little bit of income. I'm keeping my bets very small right now. Folks, this is a low probability trading environment, okay? This is when you want to really pull back on your trading activity. And one of the biggest mistakes that novice traders make is that they've got to be in there all the time, hammering the market, thinking that I've got to be trading, I've got to make money. I'm not doing my job if I don't have a bunch of trades on. The reality is that the market moves in ebbs and flows, and you're going to see instances where you have really high probability setups, okay? So you know that I was telling you that from 2023, we had really nice, powerful move. Any kind of pullback was going to present us with a great buying opportunity in the fall. I didn't know that we would get this big of a pullback below the 200-day moving average, but we did. And when we broke through this downward sloping trend line and the 100-day moving average, okay, this is when both guns drawn, you come out ablazing. And if you go back and you watch my videos, I am jumping up and down on top of my desk saying, buy, be aggressive, add, be really aggressive here. This is a really good breakout. We've got volume, we've got everything. Nice, tight, orderly price action. This is when you get aggressive. This is when you make your money and you hit it hard. And then the market starts to lose its momentum and you go to the sidelines. That's what you have to do. If you keep trading right here like you traded here, you're going to give it all back. We get a nice little opportunity in here. This strength tells us that this little dip is going to present a buying opportunity. Until we see support, we are only focused on the long side. We are not even thinking about shorting, the exception being some day trading shorts. But our focus, we never lose our focus. We are looking for support and we want to buy. This is where we didn't get super aggressive because these candles were not green off to the moon. No, they're mixed, they're overlapping. Maybe we test the 100-day moving average again. This is a wimpy bounce and it came on light volume. So we take a starter position here, but we add to the position here on this breakout. So that's how we approached it right in here. We couldn't get gangbuster long like we did in here. And now you're starting to see some choppy price action. And a little bit of toppiness, not bearish, just neutral is all get out. So you take some of your long swings off, you go to a cash position, you start looking for maybe some bearish call spreads that you can sell if you get a nice little rally to the upper end of the range. Market pulls back, you look to sell some out of the money bullish put spreads. You're constantly trying to just make a little bit of income in this low probability trading environment where the market is probably going to be stuck in a trading range. Tiny little bodied candles. Look at these tiny little candles. Ain't nothing going on here, folks. Do not trade heavily right now. Pull back your activity. Try and find really nice stocks with relative strength and relative weakness. And even when you have them lined up, you're still using a conservative options trading strategy by distancing yourself from the action and taking advantage of time premium decay. That is how you need to trade at least for the next couple of months. We need a catalyst. We need a breakout. We need some long candles. We need some volume. We don't have any of that. So please don't piss your capital away right now. You'll be really upset with yourself when good trading opportunities set up like this one. That's when you want to have your money ready to deploy. You just have to be patient and wait for it to set up. Thanks so much for watching. We will see you Wednesday for the live event. Make sure that you watch for that. Thank you.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.